I'm Bridget Stomberg.
And I'm Lisa DeSimone.
And this is Taxes for the Masses.
Today's episode is on Code Section 83B.
Internal Revenue Code Section 83B outlines the income tax treatment of property, like restricted stock or stock options, that employees receive as compensation. The code section is important because it determines when and how individuals include the value of the stock or the options in their gross income and when their employer can take a deduction. In today's episode, we outline the mechanics of Code Section 83B and discuss some academic research that examines why some firms limit their employees' ability to make favorable tax elections permitted by the code section. Hello, Lisa.
Hello, B.
Today we are talking about a very specific code section.
Very specific, yes.
We're getting into the letters.
Yes.
We're not just talking about 83, we're talking about 83B.
Fair point, yes.
And that makes me happy because I am a nerd and I like talking in code sections.
Yes, you are a nerd. It's true.
And I know it's obnoxious. I know it sounds nerdy at best, but it brings me joy to do so.
Okay.
And this is one of those, this is like 401k. Like the code section has become the thing.
Yes.
So you might hear people talk about 83B elections.
Yeah.
But before we dig into that, what are your feelings about integrating code sections into everyday conversations?
It's a good way to make people not like you.
I was going to say, it's a good way to end the conversation.
It's a very good way of ending the conversation. So, almost as good as, well, what is it that you do? I'm a professor. And what do you teach? I teach tax. And then the conversation is over.
Oh my God. Thank you for saying that. Because I say this, I've told this story so many times. You like get in an Uber, you get in a Lyft. Yep. What do you do for a living? I'm a college professor. Oh, what school? Business school. Oh, what do you teach? Tax. Oh, like you can see the increasing disappointment.
Yes.
In you taking what they thought was a cool job.
Yes.
And turning it into tax accounting.
Thankfully, both of us were raised to expect people being disappointed in us.
Absolutely. Oh my God, it comes in handy, doesn't it?
It does.
Wow.
It does.
Silver lining. Okay, so happy that we're gonna make everybody turn the episode off because we're talking about 83B. But really I'm happy because we get to talk about stock compensation, which I love.
I know.
As you know, it is one of my favorite tax topics. And this particular topic actually has practical implications.
Okay, good.
And I'm going to guess that when you teach graduate students about compensation in your classes, I would think this topic has to come up.
83Bs?
Yeah.
Oh, yeah. We do days on this.
But do they talk about it? Like, have you ever had a situation where a student like wanted to seek out your advice to talk about this code section?
Oh, yes.
Okay. Say more.
Usually it happens after they've taken my class.
Okay.
And the conversation, the email goes something like this. I took your class. Remember me? It was in, this year, this semester. I didn't listen when you were talking about stock-based compensation because I didn't think I was going to get any, but I'm changing jobs and now I have this whole choice in front of me of what to do about all the stock-based compensation. Could I please use up more of your time now that you're no longer my professor to talk through this? And I'm being a little rude because I'm totally happy to take that call because I love talking about this stuff, but just don't remind me that you didn't pay attention when I taught you this in class.
Correct. And a note to all the students out there who in the future might want to send a similar email. It could be something like, I remember some of the things that we talked about, or I remember discussing, but I wanted to get your input on my particular situation.
Yes.
That might be a better way to do it. All right. Splendid. So today we're going to try to accomplish two things. I feel like we always used to try to do three things.
Okay.
But now we've downsized shrinkflation.
Good. I like it. Let's set lower standards for ourselves.
Absolutely. So today we're going to try to do two.
Okay.
We're going to talk about what Code Section 83B is, why it exists, how it works.
Love it.
And then we're going to talk about some research by Jennifer Bluin and Mary Ellen Carter that investigates corporate policies that prohibit employees from taking advantage of the taxpayer-friendly parts of 83B.
What?
Bastards.
Bastards.
Sound good?
Sounds good.
Okay.
Let's start with the basics. What happens when you get restricted stock as part of your job?
It's a great question. And so we're going to imagine that you work for a company that gives you shares of its stock. But there's a catch.
Okay.
You don't fully own them unless or until you've worked at the company for a certain period of time or you've met some sort of performance goal, like having the share price reach a certain target.
Okay.
Once you've done whatever it is you need to do to fully own those shares,
Yes.
that's when they quote unquote vest.
This is not an item of clothing.
It is not. This
Okay.
is not a sweater vest. This type of stock compensation is often referred to as restricted stock because there are restrictions
Yes.
on what you can do with the shares until it vests. So because of that, these shares are what we call subject to a substantial risk of forfeiture. Because if you leave the company before they vest, you might lose them and not get any value at all. So the million or perhaps multi-million-dollar question here is, when do you pay taxes on something that you sort of kind of own, have, but that is subject to this substantial risk of forfeiture? Is it when your company first gives you those restricted shares, or is it when they vest and those restrictions lapse and you can do whatever you want with them?
So the general rule of Section 83A is that you don't typically pay tax on restricted property when you first receive it because it's not yours yet.
Makes sense.
Instead, your tax bill is going to come due the first time your rights in that property become transferable, or you are not subject to a substantial risk of forfeiture, whichever occurs first. And I'll just note, in either case, usually at that point, you're considered like you have the value of the stock.
Yep.
It is yours.
Yes.
It belongs to you.
Yes.
It usually happens when the stock vests. And at that point, the fair market value of the stock minus anything you paid for it is included in your ordinary gross income.
And already I want an example.
As you wish. Say Cora receives 1,000 shares of restricted stock from her employer in 2023 when they're worth $25 each, so $25,000 of value total.
I'm with you so far.
Okay. The shares fully vest in 2 years. Cora pays nothing to receive the shares, which are worth $35,000 when they vest at IPO, and she immediately sells the shares. So under the general rule, the standard default rule, if you don't do anything fancy, Cora would include $35,000 in her gross income in 2025 when those shares vest, and she would pay ordinary income tax rates, let's assume 25% for her. So that's going to be $8,750 of ordinary income tax. She then gets a $35,000 cost basis in the shares, which she immediately sells. And so she has no capital gains, and the total tax bill would be that $8,750 of ordinary income that she paid upon vesting.
Okay, so this is an example that some people might find themselves in. We said IPO, so the idea here is probably that Cora is working for a startup. She's getting these shares when the company is still private, and then she's going to cash out when the company goes public.
Yep.
She's getting $35,000 worth of stuff in exchange for working for the company, and so that's why under the general rule, Congress is like, okay, well, this is ordinary income. You're going to pay it ordinary
Exactly.
rates.
Yeah.
All right. So generally, you're going to be taxed when the stock vests. You're going to be taxed at ordinary income rates on the full fair market value of those shares when they vest.
Yes.
We good?
Great.
That's 83A.
Yes.
Tell us about 83B.
Yes. So 83B is an election. It's a choice that an individual taxpayer can make. And what they're doing with electing 83B is they're saying they want to accelerate the income recognition.
What? Why would I ever do that?
Yeah, this is usually not something we usually play with timing
Yes.
as deferring things.
Yes.
Like we don't want to pay now, we want to pay
No.
later. But here, what we're doing is we're saying we don't want to wait until the restricted stock vests. We want to elect instead to include its fair market value in gross income in the taxable year in which you receive the property.
Okay, so we've apparently just violated the first rule of tax planning,
Yeah.
which is not, in fact, don't talk about tax planning.
No.
But rather it's don't recognize income until you have to. So please, 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 why would anybody want to pay taxes sooner than they absolutely have to under the code?
Yeah, and that's yet another possibly multi-million-dollar question.
Okay.
In the example we just gave, the stakes aren't that high.
Okay.
The shares appreciated only $10,000 from the date of grant to the date of vest. But what if you're getting restricted stock from a company you think is going to perform really well? Like you're a founder and you think it's going to perform like really, really
Okay.
well. If you make the 83B election, the value of the stock upon grant is taxed as ordinary income. But here's the magic. Any appreciation in the stock's value after that election date is going to be taxed at the lower capital gains tax rates when you eventually sell it.
Okay, so now I get it. If I expect my company's stock to skyrocket, like you
Yes.
said, maybe because I'm working for a hot startup, I might want to pay taxes earlier because I think I'm going to pay taxes on a smaller amount.
Exactly.
So I think I'm getting in on the ground floor.
Yep.
They're giving me that stock when the value is relatively low.
Yep.
I would happily pay a higher ordinary rate on that tax sooner to pay a lower capital gains tax rate on the appreciation later.
Exactly.
Okay.
Yeah, you're basically gambling. You're putting a wager on that future stock price going up quite a bit, and that wager can pay off pretty big.
Okay.
So let's go back to our example. Imagine that Cora's employer still wants to grant her 1,000 shares of restricted stock when each share was just worth $1.
Okay.
Like, this is really the ground floor,
Like you're
right?
saying founder stock, basically.
Yeah. The shares fully vest in 2 years and are worth $350,000 when they vest at IPO. With an 83B election, Cora is going to recognize 1,000 shares at $1, so $1,000 of ordinary income at the grant date, and take $1,000 basis in those shares, paying $250 in taxes at a 25% ordinary tax rate. When she sells the shares for $350,000 at IPO, the gain of $349,000 is taxed at capital gains tax rates of only 20%. And that tax rate, or that total tax, is only going to be about $70,000.
Okay, so that's a really powerful example. She was only taxed at that 25% ordinary rate at that $1,000 value when she received it. Mm-hmm. The rest of it gets taxed at only 20%. Mm-hmm. Whereas without that 83B election, the entire $350,000 would have been taxed at that 25% rate.
Yes.
So if we ignore the time value of money, you can see that that election is going to save her a lot of tax dollars, real dollars, by essentially swapping a larger chunk of ordinary income for long-term capital gains.
That's right. And this is especially handy with high growth companies because the bigger the appreciation, the more tax you can save. Also, the higher tax rate, the more tax you can save, right? Remember, the capital gains tax rate tops out at 23.8% when you include the net investment income tax, whereas the top ordinary tax rate is 37%.
Yeah.
And so if we were to use those rates in the example, the savings jumps to, even higher.
Absolutely. Okay. So that all sounds great.
Okay.
Paying taxes sooner on a smaller amount, but at a higher rate.
Yes.
Stormy Bear here.
Yes. Stormy Bear, tell me what's wrong with this
There's
scenario.
got to be downsides.
Okay. Yes.
Okay? So like you just said, if you make the election and the stock price declines, then you've essentially overpaid taxes.
Yes, you have.
On something. That's not great.
You cannot get that tax back either.
No.
No.
Also, if you make the election and then you forfeit the stock, let's say you don't stay at the company for the 2 or 3 years or whatever you did, then you also don't get any benefit from the tax that you already paid.
That is correct.
So you got to be pretty sure of two things, that you're going to stick it out and that the stock price is actually going to appreciate, and that it's going to appreciate enough to make up for that additional tax.
Yes.
Okay.
Bottom line, you have to think very carefully about whether the election makes sense for you.
It's going to be individual circumstance specific.
It is.
Okay.
It might make sense if you receive restricted stock with a really low market value at the time of grant, such that there really isn't a whole lot of taxes that you even have to pay at that point in time because the valuation is so low.
That's another good point. You have to actually have cash on hand to pay the tax.
Yes.
Yeah. Okay.
Yep. But in any case, you got to at least believe that the share price is going to increase over time, or at least not decrease, right? The risk of forfeiting the stock should also be small, meaning that you plan to stay with the company. You don't think you're going to get laid off.
Okay.
And you don't think that the company is going to be acquired before your stock vests, because guess what? If the company gets acquired, they are triggering the sale of your stock for you.
And you're not having control over when that
happens. You do not have control.
Okay. Okay. Yeah. Another kind of trap for the unwary, I guess you could say, is that even though making the election is simple, you just have to fill out a form, you have to do it within a certain amount of time.
Yes.
So you have to let the IRS know that you're making that election no more than 30 days after you receive the stock.
Yes.
I said nothing about the filing of your tax return.
Correct.
So this is not an April 15th situation.
Nope.
There's a lovely form that you get to fill out. New in 2025. New. Form 15620. I don't know why we've gone to 5-digit form numbers.
I don't either.
I don't like it. But you fill it out, you send it to IRS, and voila, you've made a tax election.
Yeah.
Yeah.
I love new forms. I'm excited by the new form.
You're excited by a new form?
I am.
Is that really how you want to end this part of the show?
It is.
Okay.
B election sounds like it could be a great deal for employees if the stock is expected to appreciate and all of those other considerations work out. But here's where it gets interesting.
Okay.
What about the company's perspective?
Yes.
Yes.
The tax deduction.
Yes.
All right. So you're getting this stock for compensation.
Yes.
And we know that companies can deduct compensation.
Correct.
All right. So the tax deduction to the employer, the tax benefit for the employer, happens at the same time that the employee recognizes the income. Mm-hmm. And that makes sense because someone is picking up income and paying tax the same year that another taxpayer is taking a deduction and saving tax. It kind of balances things out.
Yeah.
There's a nice harmony to it.
Yes, symmetry.
Symmetry. The universe is in a nice place.
The tax code makes sense.
It does.
Yeah.
It used to.
Yes.
But it also creates a potential conflict.
Yes.
Okay. So an employee might want to make an 83B election to lock in those lower capital gains rates on appreciation.
Yeah.
But the company's on the flip side of that, right? Because if any reduction in the income the employee picks up also reduces the deduction that the corporation is getting. So the company might actually prefer that the employee doesn't make the election because if the stock appreciates, the company would get a larger tax deduction when the stock vests.
And this is where a study by Jennifer Bluen and Mary Ellen Carter provides some insightful findings. The authors look at why companies would actually restrict their employees' ability to make or not make this 83B election. And this is a novel area because previous research largely ignored the employer side of this decision.
Yeah, and it's worth noting, obviously, that employers can limit your ability to do this.
Yeah.
Their research suggests that companies that prohibit employees from making an 83B election often do so because of the tax consequences. These firms typically expect significant stock price appreciation, and by prohibiting employees from making the election, they're basically ensuring that they're going to get a larger tax deduction in the future when the stock vests at a higher value, and the employee has to include that as ordinary income.
Yeah. So the company's winning on taxes, but at the expense of employees.
Absolutely.
Employees in these firms generally end up paying more taxes than if they had been allowed to make the election because all of that appreciation gets taxed at ordinary income rates when it vests.
But interestingly, companies not only prohibit employees from making the election, they can actually require employees to make the election.
And that's where it gets a bit more nuanced. Firms might require the election if they expect only modest stock price growth or want to get an immediate tax deduction today, especially if there's a risk that the restricted stock might never vest. However, the study found mixed evidence that requiring the election is always about efficient tax planning for the firm.
Okay, say more things.
Yeah, so a key factor is gross up bonuses. Sometimes when a firm requires the 83B election, they also pay a cash bonus to the employee to cover that immediate tax liability that they've required the employee to pay.
Got it.
And the study found that when these bonuses are included, firms that require the election are on average actually paying out cash rather than saving cash from the tax deduction, which doesn't sound smart.
No.
And the study suggests that for these companies, requiring the election and paying bonuses is likely driven by non-tax reasons.
What? People do things for non-tax reasons?
They do, especially when it comes to stock-based compensation.
Very true.
So it might be a way of kind of handcuffing the employee to the firm.
Yep.
Or to, put it more nicely, that they're trying to retain talent.
Yes, I never liked that handcuff phrase.
Yeah. Employees in these cases are actually better off because the bonuses do cover their taxes. So they're saving on taxes and they're getting it covered by the firm.
So to sum it all up, firms that prohibit the 83B election are often doing it to maximize their own tax benefits at their employees' expense.
Yeah.
But firms that require their employees to make the 83B election, especially those that provide gross up bonuses to cover the immediate tax liability, might actually be prioritizing employee retention or other compensation goals over strict tax efficiency.
Exactly. This highlights the push and pull between employer and employee interests when it comes to compensation and how tax rules play a part in those decisions.
So this whole conversation has brought up, I think, an overdue question.
Okay.
And I'm kind of embarrassed that I haven't asked it before.
Okay.
What is our 83B election policy here at Taxes for the Masses?
Well, we're not a C Corp nor public, nor granting anyone stock.
More profitable.
Or cash for that matter. So I'm going to say the policy here at Taxes for the Masses is not super relevant.
Thanks for that.
Now, if we ever had employees and paid them with stock, I'd like to think we would do it in a way that was in their best interest.
Me too. I think we're that kind of business.
We're those kind of managers. Okay. Yeah. for the good, the bad, and the ugly.
Ooh. I want to start. Can I start? Me, please. Call on me.
B.
I like that we did another compensation episode. Yes.
I had a feeling you were going to say that.
I did.
I like that the topic has practical implications for employees.
Yes.
And that, you know, it could help some of our students graduating and going to work for startups.
Absolutely.
Do a better job managing the tax liabilities associated with their compensation. Should they pay attention during class?
Please pay attention during class.
Yeah.
I'm going to apologize for throwing shade at your form comment earlier, your excitement over the new form.
Okay.
I'm going to apologize because that's actually a good thing too, I think.
That you're apologizing?
No, that there's a form.
I think there's a good thing. I'm confused.
Okay.
Why are we I thought forms were good.
You did say forms were good, and
Yeah.
I think I kind of was like, you're
You
really
gave me
excited
crap
about it.
about
I
it.
gave you crap about it, and now I'm taking it back.
Okay.
Because this form is good.
Okay.
Because there's currently not a lot of data out there that researchers can use to examine things like how common are these 83B elections?
Yeah.
Who's making them? Who's not
Yeah.
making them? Who's benefiting from them? And now that there is a form required,
Yes.
I'm hopeful that we can gather more data and learn more about these elections.
Ooh, I like that
Which
idea.
we couldn't do before. Because
I like
before you
that.
just like send a letter to the IRS and you're like, yo,
Yeah.
83B.
Right.
So I was too hasty in my unwillingness to celebrate the form.
Your groveling and apology has been accepted.
Thank you.
And your reward for your apology is that we can talk about the bad.
Yes. Okay, the thing that I don't like about this, and it's not just this election, it's like lots of elections. Could we just, like, do you really need to know before the tax return? Like, do you really need to know
Right.
before I file my taxes? I don't like the how time sensitive it is.
It's incredibly time sensitive.
Incredibly time sensitive. 30 days. Like, you really need to know, A, that this is a choice you have, and then B, you have to be like super proactive about it. I'm not sure how many people know what this 83B election is or that it can save them money.
Yeah.
So you said that you've had students talk to you about this. Has any student
Yeah.
like missed out on this opportunity?
Yes. And it was extremely costly.
Okay.
So she was a founder of a firm.
Oh gosh, she
They had
started
this-
a company?
Yep.
Okay.
They had a giant stack of paperwork that all the attorneys and everybody, the investors said, like, you need to get through this stack and make sure you get everything done.
Yeah.
And the 83B election was like at the bottom of the stack, and she
Okay.
did not get to it within 30 days. And so suddenly started having stock, like with a subsequent round of investors.
Yeah.
She was having stock vest for herself at a valuation that was above her compensation. So she could not pay the
Oh
tax
my gosh. Okay.
on it.
Okay. Yikes.
Yeah. And it took a very costly reorganization for them to fix the
Oh
problem.
my gosh.
Yeah.
Really?
Yeah.
That's a pretty dire consequence.
It's not good. Yeah.
I mean, you and I think about taxes. Is it every day?
I mean, yes. Yes.
But I'm willing to admit that we're not the average person.
No, no.
Right? Like
No.
people think about tax.
And to be clear, we're not saying we're above average
No.
here. We're saying we are way off the tail of the distribution,
No.
probably on the bad side.
Not in a good way.
Yeah.
People think about tax in April.
Yeah.
Make the election due in April. Or I don't know. I don't like it.
Yeah.
Ugly.
There are some really scary. So I teach a case based, a real life case
Okay.
based on good technology. A small company that was, doing tech stuff, and some employees borrowed money in order to exercise stock options
Okay.
that were restricted stock.
Yeah.
And paid a lot, basically, and exercised 83B.
Yeah.
Like they paid tax, they exercised options, which you have to pay money to
Yep,
do,
yep.
and they borrowed money to do this, only to see the valuation fall because
gosh. Mm-hmm.
it was a pre-IPO company that never made it to IPO and eventually had to get acquired below valuation. So yeah, I worry that rank and file employees may not fully understand
Yeah.
the risk that they are taking when they agree to put up their own cash to get something that is not theirs yet.
Yeah. That's very true. And in this case, borrow
Yes.
to do it. That's extreme.
Very scary.
Don't like that example.
Yeah.
Well, again, it is nice that we have this tax form because this was the only research paper that I know of that looks at this in any way. And they're really kind of looking at it from the company perspective, because I think companies disclose in some SEC filing what their 83B policy is. And so it would be nice to know more about how common these things are, who
Yes.
benefits, and hopefully with this new form, we'll get all that information.
Let's hope for some good new research.
Because I'm sure the IRS is it's going to be very well documented.
Yeah.
And
they're going to get right on that.
Mm-hmm. Yes. Looking forward to it.
Well, that's all we have time for today.
Be sure to join us for more tax nerdery on future episodes of Taxes for the Masses.